You wake up to a breaking news alert. Markets are crashing. Pundits are shocked. Politicians are monitoring the situation. But somewhere, hours earlier, before the headlines, before the panic, before you even opened your eyes, the markets already knew. Not metaphorically, not poetically, literally. Prices had already moved. Billions had already shifted. Positions had already been taken. The future, your future, had already been quietly priced in. And that raises a disturbing question. If financial markets seem to predict the future, who exactly is telling them what's coming? Because it's not magic, and it's definitely not luck. This matters right now because we live in a world where markets react faster than governments, faster than newsrooms, faster than experts, and sometimes faster than reality itself. Interest rates jump before central banks speak. Stocks fall before layoffs are announced. Currencies collapse before crises are officially acknowledged. It can feel like the market is a crystal ball, but it's not predicting the future. It's calculating it. To understand how, you have to stop thinking of the market as a place. It isn't a building. It isn't a website. It isn't a chart. It's a machine made of expectations. Every trade inside that machine is a bet, not on what is happening, on what will happen. When someone buys a stock, they're not saying, this company is good today. They're saying, I believe this company will be better tomorrow than everyone else expects. That difference between expectation and reality is where all profit lives. Now scale that idea up. Millions of investors, hedge funds, banks, algorithms, governments, pension funds, insurance companies, all making bets all the time, all trying to be slightly less wrong than everyone else. That competition creates something strange. The market doesn't wait for events. It races to imagine them first. Think about a company about to release earnings. The numbers aren't public yet, but analysts have estimates. Traders have models. Insiders have hints. Suppliers notice order changes. Employees sense internal tension. Shipping data leaks. Satellite images track factory traffic. Each person sees a fragment. The market combines them. The price you see on a screen is not the present. It's a consensus forecast of the future. That's why sometimes a company announces record profits and its stock falls. Because the market wasn't asking, are profits good? It was asking, are profits better than what we already expected? If expectations were higher than reality, the price drops. Even if reality looks impressive to everyone else, that's the first uncomfortable truth. Markets don't react to news. They react to surprises. And surprises are rare when thousands of professionals are paid millions to anticipate them first. This is where the machine gets unsettling. Imagine a global network of people whose full-time job is to detect tiny signals before anyone else notices them. Not obvious signals, micro signals, freight rates, commodity shipments, bond spreads, options activity, weather patterns, shipping insurance costs, currency swaps. Individually, each signal means almost nothing. Together, they whisper, and markets listen. Take something as simple as the price of oil. Most people think it moves when wars start or when OPEC announces production cuts. But often, oil prices move days or weeks before those announcements. Traders notice tanker bookings, insurance premiums in certain regions, port congestion, even satellite images of storage tanks. By the time the news breaks, the price has already moved. The headline feels like the cause, but it was actually the confirmation. This is why financial markets often look like they're psychic. They're not seeing the future. They're aggregating information faster than any human institution can. The news reports events. Markets process probabilities, and probability is quieter than news. Here's where the math gets uncomfortable. Suppose there's a 70% chance a country will default on its debt in the next year. That doesn't mean it will default. It might not. But markets don't wait for certainty. They price the risk immediately. Bonds fall. Interest rates rise. Currency weakens. To the public, it looks like panic. To the market, it's arithmetic. Price equals probability multiplied by outcome. That formula is why markets can look wrong for months and then suddenly look brilliant. Because they weren't predicting one outcome. They were pricing all possible outcomes. When people say the market was wrong, what they often mean is the outcome with lower probability didn't happen. But markets don't deal in certainty. They deal in odds, and odds can look foolish right up until they're right. There's also an incentive hiding inside this system that almost nobody talks about. Speed is money. If you know something 1 second before someone else, you can trade before they do. That's why trading firms spend fortunes to shave milliseconds off communication times. Fiber optic cables laid in straighter lines. Servers placed physically closer to exchanges. Algorithms designed to react in microseconds, not to understand the future better, to act on it first. In that environment, information itself becomes currency. The earlier you get it, the more valuable it is, which means entire industries exist solely to obtain information slightly sooner than everyone else. Not secret information, early information, shipping logs, credit card spending data, web traffic, crop yields, patent filings, job listings, import records, electricity usage, even parking lot activity. If reality leaves footprints, someone is measuring them, and the market is where those measurements get translated into price. This is also why markets sometimes move in ways that seem detached from everyday life. You might walk through your city and see busy restaurants, crowded malls, construction everywhere, and still watch the stock market fall. It feels absurd, almost insulting, but the market isn't pricing what you see. It's pricing what it thinks you'll see 6 months from now. If investors believe growth will slow, prices drop today, not when the slowdown happens, today. Which leads to one of the strangest ironies in modern finance. Markets can cause the future they predict. If investors believe a country is risky, they demand higher interest rates to lend it money. Higher rates make borrowing more expensive. Expensive borrowing strains government budgets. Strained budgets increase default risk. The prediction changes behavior. The behavior creates the outcome. It's not prophecy, it's feedback. And feedback loops can be brutal. Consider bank runs. A rumor spreads that a bank might be in trouble. Depositors withdraw money. Withdrawals weaken the bank. The bank becomes unstable. The rumor becomes true. The market didn't foresee collapse. It accelerated it. That's the hidden mechanism most people miss. Markets aren't observers. They're participants. Their expectations don't just reflect reality. They shape it, which makes the relationship between headlines and markets almost backwards. People assume news drives prices. Often, prices drive news. Journalists write stories explaining why markets moved, but those explanations usually come after the move. The price changed first. The narrative arrived later. The story is built to match the chart, not the other way around. This doesn't mean markets are always right. Far from it. They panic. They overreact. They chase trends. They form bubbles. They crash spectacularly. But even when they're wrong in a very specific way. They're wrong collectively. Millions of decisions, each rational on its own, can combine into something irrational, like a crowd running toward an exit that doesn't exist. And yet, over long stretches of time, markets still tend to incorporate information faster than any single expert, institution, or government body, because no central planner can match the processing power of millions of competing minds with money on the line. That's the real engine. Risk. Opinions are cheap. Predictions are everywhere. But when someone is willing to bet real money on a belief, that belief becomes data. Markets are machines that convert conviction into numbers. And numbers don't care about confidence. They only care about accuracy. So when prices move before events happen, it's not because someone knows the future. It's because thousands of people disagree about it. And the price is where their disagreement settles, which brings us back to that unsettling feeling. You wake up, you check the news, something big has happened, and the chart shows it was already expected. It can feel like you're late to your own life. But maybe the more important realization is this: if markets seem to know the future before you do, it might be because they're not waiting for the future at all. They're constantly rewriting it. And if a system built on expectations has the power to move economies, shape policy, and alter real-world outcomes, then the real question isn't whether markets can predict what's coming. It's who or what they're listening to when they decide.